Mark, we're going to keep it in Europe for the time being. Talk about Latvia. That country is teetering on the brink of economic collapse. And Stockholm-based Swedbank, the largest bank in the Baltic states, says it's prepared for a potential currency devaluation in Latvia. Bloomberg reporter Kim McLaughlin has been following the story from our Stockholm bureau. Kim, so what happens if Latvia goes ahead and devalues its currency?
Well, the effect on some of the Swedish banks will be very direct. The two biggest lenders in the Baltic region are Swedish, Swedbank and SEB. And essentially, although many of their borrowers may have taken loans in euros, their ability to repay those loans will be put into question. And Swedbank and SEB may have to write down the value of those loans, take a hit to their profits, and essentially take billions of dollars of write-downs.
Now, is this just confined to the Swedish banks, or is there perhaps a broader fallout that may extend beyond write-downs?
There is a broader fallout, and that's about investor confidence. Essentially, if one of the emerging market nations or the Eastern European nations devaluates its currency, investors fear that others may follow suit and that asset prices across the region may be put under pressure.
All right, now, just last week, I recall seeing a headline, the Latvian central bank saying that it wanted to maintain the peg of the Lats to the euro. What other alternatives do they really have, though, if that situation, if their hand is forced, let's say?
Well, they're stuck between a rock and a hard place. Essentially, either they choose to undertake very austere budget requirements imposed by the IMF and the European Union, equal maybe to about 9 or 10% of their total budget. This has huge social costs in the country. Or they choose to devalue the currency, which may give a short-term gain in the form of boosted exports and maybe mitigate some of the effects of the financial crisis. But in the end, it will definitely hurt investor confidence in their nation.
Okay, Kim, we know that the world economy is on its knees. We know that we're still in the middle of a financial crisis. But why Latvia?
Well, like a number of other emerging markets in Eastern Europe, they had fantastic growth in 2005 through 2007. The GDP expanded there by more than 10% per year in those 3 years. And as investors fled Eastern European countries in order to shore up and bring investments back home to handle their own investment problems in developed markets, that has simply undermined the entire economy there. Also, Latvia, because it has a currency peg and its currency has not been able to float freely and sort of adjust to a lower level of many of its trading partners, it's stuck with these high costs and high wage costs.
All right, Kim, thank you very much. That is Kim McLaughlin reporting on the Latvian situation from Bloomberg's bureau in Stockholm.